and welcome to this webinar on using comparables in technology valuations, led by Joe Dillon. Before we get started, I'm just going to do a very brief introduction to EBD Academy, as it is a very new brand and new training organization that's just been set up this year. So EBD Academy launched this year at BioEurope Spring back in March. That was back in Barcelona. And the EBD Academy is born out of a partnership between EBD Group and Pharmaceutical Training International, who are based in London. Both of these companies are both part of the Informa Group, hence this partnership forming. And the aim of EBD Academy is to provide specialist training that's committed to the personal progression and employability of professionals involved in pharma, biotech partnering, so licensing, funding, etc. Basically the EBD community. We are currently running EBD Academy courses and well-known EBD events, and some of those are listed here on this slide, such as Biopharm America, BioEurope, Biotech Showcase, and BioEurope Spring. So if you're ever affiliated with any of those or attending any of those events, you probably will see the EBD Academy logo. And the aim of the Academy is to have a large portfolio of courses that are basically all three of these formats and mediums. So we'll be doing face-to-face courses, which are classroom-based, which will be either co-located at EBD events or standalone. We'll also be doing lots of online courses, and also there's the option of in-house customized bespoke courses where we will deliver courses at your facility. And that is literally all I'm going to discuss about the EBD Academy. If you have any more questions, feel free to email this address or visit the website listed there.
Excellent, thank you, and thank you for everyone for attending our webinar today. So my name is Joe Dillon. I'm the president of Dillon Capital Strategies. We're a consulting and advisory firm, and we specialize in biotech and pharma transactions, valuations, deal structuring, and those sorts of activities, and supporting business development in general. So using comparables and technology valuations is near and dear to my heart. So let's dive in. The topics that we're going to cover today are, first of all, coming to a level set understanding on what we're talking about when we refer to a comparable. Then we'll go into how they fit in with other valuation methodologies and dive into identifying comparables and things that I do to identify comparables. And then we'll show you a few examples of comparables, or actually real deals with the public and the formerly confidential information of those deals to see if they would or would not have been a good comparable. We'll wrap up with the pros and cons of using comparables and hopefully leave enough time towards the end for a Q&A session. And I think, as Alex said, if you have a question, just go ahead and type it down in your chat box down there. It'll go off to Alex and he'll ask me the questions towards the end. So let's start with what is a comparable. So if you Google it, it says that it is something of equivalent value worthy of comparison. So when we use these in the technology industry, especially in biotech and pharma, what we normally are referring to is a product or a technology that we believe is in some significant way comparable to the product or technology that we're trying to evaluate or value. Sometimes it's also used as comparable companies if you're doing company valuations. So that's what we're talking about today. There's a few subsets of that here towards the middle of the slide. Comparables for sales transactions tend to be somewhat different. And this is a sale of a company or potentially the sale of just a single asset, maybe a set of intellectual property. That's somewhat different from comparables that we might use for licensing deals and other deals that are what are considered non-sale deal terms, and that can include certain partnerships and joint ventures. The third one listed here is actually when I use comparables the most, and this is using comparables and especially other products that have been on the market and have some history, and using those as a guide to do revenue forecasts for a product that I'm doing evaluation on, figuring out the uptake curve in the market, how it might react to certain market conditions. If I can find out the information, it might give some guidance on R&D costs for certain types of programs. There are a few outfits, and one of them that I like is Damasi at Tufts University, that uses comparables to come up with databases for probability of success for various types of biopharma products, and he slices and dices it up by therapeutic area and diseases and phase of development, so you can get a good idea for probability of success using comps and maybe other expenses or financial aspects. So this is actually my widest use of comparables. You may have heard of comparables called other things. The things listed at the bottom here, some are synonyms, and some of them are just similar terms. Standards, multiples, rules of thumbs. Those are usually averages that are derived from sets of comparables. An analog is a term that's used to describe, in my experience, usually a product that you believe is comparable to the product that you're analyzing, and you'll call that product perhaps not a comparable but an analog because you're using it as a model. And if you're a statistician, you might be using terms like averages, means, median, mode, and so on. So that's what we're talking about today. So how do they fit in with valuations? It's important to keep this in mind. When you do evaluation, there are three basic methodologies that are accepted methodologies for valuations. There's a variety of ways to do valuations, but generally speaking, they fall into one of these three buckets. And that is the market methodology, the cost methodology, and then the income method. So let's go back up to the market method because that's where comparables fall in. Comparables are a market method way of doing evaluation. When you use the market method, you really need to have a large number of deals, or at least a statistically significant number of known deals, and to have assets that are relatively easy to compare to each other. And this is why it's in such high use in the real estate industry. If you have your house appraised, they most likely will use a comparable type of an approach. It's much more difficult to apply in biopharma, even devices and diagnostics, because it's much harder to compare technologies one to the other than it is to compare, say, one house to another house. But it can still be done, and we'll talk about that. The cost method, there in the middle, you may have heard this referred to as the asset or investment method, maybe the payback method. And what you assume if you use the cost method is that a higher investment in manufacturing or higher investment in the product to make it and bring it to market will generally lead to a higher value of that product, or maybe a higher price for the product. This doesn't really hold usually in biopharma. It might hold in devices and maybe some diagnostics, but generally speaking, we know that just the mere spending on research and development in biopharma doesn't mean you're creating more and more value, unfortunately, because of the high failure rate in earlier programs. So the cost method is usually used in capital, labor, material intensive kinds of industries and for their products. Then the last one is the income method. This is most commonly called the net present value method or discounted cash flow, DCF. And what you do here is a forecast of future cash flows, and I usually do my forecasts out 20 years and base the value on that stream of future cash flows. And this works really, really well for high technology and patented technology, and that's why almost all buy-side pharma and biotechs use the income method or net present value. But let's go back up to the market method because that's what we're talking about with comparables. So the question is, when should I use comparables? You know, if we understand that the income method really is preferred in a lot of cases, when is the time to use comparables? And here's a list here, and you might be able to add some of your own to this list. But when I'm doing a valuation of a research enabling technology, oftentimes it's very, very difficult to come up with a defendable cash flow of what the economic impact of that technology might mean in research enabling. And if that's the case, we turn to comparables of other research enabling deals to do the valuation. I will say, though, that if there's any way that I can come up with a cash flow forecast of the economic impact, so it's more of an incremental cash flow of research enabling, I'll definitely do it and try to do the net present value, because that is a more solid platform to stand on when you're negotiating deal terms. Research compound libraries, these are oftentimes, the deals are structured around the ideas around comparables, because again, research compound library is very difficult to do revenue forecasts and things like that. Also, with some preclinical assets, especially really early preclinical assets, we may not even know the disease that it's been going for, the indication, and we might have other serious gaps in our understanding of what the target product profile might be. And when you really have that lack of understanding about the product in super early development, we might need to use comparable of other real early development deals. But I must say, most of the time for preclinical assets in bio and pharma for human health, I usually am able to come up with the target product profile, or maybe 3 or 4, and do a net present value on those. I use the comparable method along with the income method when I'm doing a valuation of company equity. Most recently, I worked with a client. They were going to go public, and they wanted me to come up with a valuation of the company and translate that into what the IPO effective share price should be. So what I did was I did an asset valuation using net present value of my client's company. And I went out and I chose, I believe it was 23 some odd biotech companies that had also gone public in the last 18 months. And these companies I felt were similar to my client. I did a top-line asset valuation of each of those companies, and I was able to come up with a multiple of that asset valuation to what their IPO effective date market cap was. And I applied that multiple to my asset valuation to my client and came up with an IPO share price that the bankers liked a lot, and they went with it. So that worked pretty slick using comps. As I mentioned before, I use this as a sanity check after I've done a net present value. I'll pull 3 or 4 or maybe 5 comps of other deals of similar technology and see if I'm in the ballpark. See how close I am to the other deals that have been done. And if I'm not close to the other deals that have been done, it doesn't always mean to me that my valuation using the income method is wrong. What it means to me is, first of all, I need to make sure I'm comfortable with my valuation, and I'm in a position then to defend why I might have a higher or lower valuation than what the comparables might suggest. And it puts me in a position to be able to negotiate if somebody were to come up with comparables and say, hey, why are you so far off this one? I will have already come up with a reason for that. The second from the last bullet is important for large companies. There are several large companies I'm aware of who have been around for decades. They've done tons of deals, and they are able to database these deals and all of the terms in them and organize them by technology, by therapeutic area, by phase of development, and other ways to slice and dice the data. What makes these databases so much more robust and useful than, for instance, a database you might be able to subscribe to third party, is that they have the confidential information from their deals. Now, they certainly don't share that out, but for internal use, they have all of the deal terms in there, so that it makes for a pretty robust database to draw comparables. And then the last point I keep referring to assist in quantifying net present value cash flow variables. I would have to say that I use comps most often for that. So I'm going to take a little bit of a step back here and put up a red flag of sorts and show you a deal that I was involved in, and what you see on the screen is what was made public. So I use a really simple deal because it makes it easy to explain. So we announced $100 million deal, $50 million up front, $50 million in milestones. So you might look at this deal and say, well, my technology is similar to that, and maybe this is a comparable. Maybe our deal should be worth $100 million. But you'd be way off if you use this as a comparable, because this slide shows what the real deal was. What we did not disclose was that there was a above average royalty involved in this deal. And if you do the probability adjusted net present value, the milestones, instead of being half of the deal value, were really only 6% of the deal value, with the royalty making up close to half of the deal. So just have to be careful and understand that you may not know all of the information if you're only working with public information. So that begs the question, how do I come up with comparables, even if we're thinking we don't have all of this secret information? And again, I mentioned it with the first bullet here. Keep that in mind. But given that, how do I do it? And the first thing I do is come up with comparables that are comparable technology. Is it a similar asset class? Is it a similar chemical class? Or, if I'm working on an antibody, I probably want to pull other antibody deals. And then I'll look at the product profile of these comparables and compare it to mine. Do I stack up better? Do I stack up about the same? Not quite as good? And it gives me an idea whether my valuation should be kind of higher or lower than certain other products out there. And once I do that and I'm comfortable, I've got a nice set of comparables, I look for these other things in the inset bullets here. The top one is really important to understand, is understanding the field of use. Did the buyer get all uses of the technology, or did they get just oncology or just certain disease areas? That can make a big difference. Did they get global rights, or do they just have Asia or Europe or the US? And if you don't get this first bullet right, you could be off by factors of multiples. Second bullet, I've always looked to see if there might have been an option involved that increases the risk of the deal and sometimes also lowers the upfront payment. And speaking of that, that's next. The upfront payment, fortunately, we usually are told that in public information. And I'll look at that and try to figure out if it might have been an option fee, especially if it looks like a low upfront payment. And when I say I try to find out, I'll Google around, and sometimes if you're patient, you'll find some disclosures that are more complete than others than if you just look at the first thing that comes up on your computer when you Google it. I'll also, if there is a public company involved, I'll go back and I'll look at the SEC database and look at their 10Q and their 10K or other public financial disclosures they might have seen. And don't forget to look at the accounting notes, because that's where a lot of this usually is. So milestones, I'm looking at that. Fortunately, they usually tell us the milestones, but unfortunately, they usually say the milestones, they state them as a lump sum, something like $400 million in milestones to be paid on X date. So I try to find out more about that. Royalty rate, this is the one that's more problematic. We might know there's a royalty, but not the rate. Are there expense sharing, subsidies, transfer price profits? Was there an equity or debt purchase that might have been at a preferential value or preferential rates? Partnering schemes, and then did the buyer take other rights to the technology? So these are all useful, and you could probably come up with some other ones to put on your checklist. So I'm not going to go through this whole slide, but I think you can get these slides from EVD, or feel free to email me for them. But these are examples of deals that are actually pretty common, pretty normal, where the stuff in black lettering is what was made public, and the red lettering that's underlined was the rest of the deal, the rest of the story that was not made public. And if you go through these, you can see that you would really not understand this deal very well, and you certainly wouldn't understand the value of the deal unless you knew the secret information. So I'll come back to this if we have time. So to wrap up, the pros and cons. The pros are, well, it's easy. The comparable method is probably the easiest way to do evaluation if you're patient enough and want to sit around for a day Googling things. It's also easy to communicate because most people understand what comparables are and how to think about them. You're probably also answering questions that are going to be asked by your senior management or your board because they ask things like, how do we stack up to so-and-so company, or what about this deal? Can we get this kind of money? As I mentioned, they makes a good sanity check too for other kinds of valuations. The cons are pretty serious though, and as I've mentioned, true comps are hard to find. Public information can be lacking. What bothers me the most though is the second to the last bullet is what I see when I see comps valuations oftentimes are assets that I feel are either being over or undervalued because it's a natural tendency to try to average comparables and think that you're somewhere in the middle, where most assets are not in the middle. They're usually closer to the upper end or lower. And you can't compare similar opportunities with comps because you'd come up with a similar valuation for all of your similar opportunities. So you have to turn to more robust valuations if you're doing similar opportunities like on the buy side. All right, so Alex, I think we have a few minutes left. If we have any questions to shoot my way.
Hi, Joe. Thank you very much for that. Yes, if anyone has any questions, please post them into the questions box and I will put them to Joe. We do have one question here, Joe.
Sure.
What if your technology is cutting edge with no comparable technology? Can you still try to use comparables?
Yeah, absolutely. And what I think the question is asking, if this is a technology that has no peer to it, like a new chemical class or a new way to use antibodies or something like that, what you would do is look at other cutting edge technologies that have come out in the last few years. May not be exactly the same as yours, but you'll be able to see how the market reacted to other technologies that had that kind of a potentially market advantage, and then you can pull those. Your valuation in total may not be the same, but you can get a better idea about demand that way.
Brilliant, thank you, Joe. I do have another one here. So it says here, what do you think of the deal databases you can buy a subscription to? Are they useful to use as comps?
Yeah, that's something I mentioned, I think maybe on the first slide. There are databases that you can buy out there. I won't mention any names here, but and they call themselves deal databases. Quite frankly, I would like to have a subscription to every one of them out there. There's got to be something useful about them. I have used them before, and the caveat is when you pull up the data that comes from these databases and you list out 30 or 40 deals, and then you go through where they list the deal terms that they have cataloged in there, you see all kinds of holes in there, royalty rates missing, milestones missing, this and that missing. And that's because they pull their information from public information just like you would if you Googled around. So you still have that problem with them, but they've done all the work of doing all of that Googling around. They have they call them spiders that go out and gather information. And it also brings to your attention other technologies that you might have missed. So I think they're of great value. You're just not going to get the secret information in there that we all wish we could see.
Brilliant, thank you, Joe. And then I have another question here. Can you explain how you use comparables to help with revenue forecast assumptions?
Yeah, I mentioned that, I think, on the first slide as well. That is my most common use for comparables. What we'll do is pull, when we're doing a market analysis, we'll pull the sales data from similar products, or perhaps we'll pull sales data for all of the leading products in a one disease area. And you can buy this specialized data through a variety of areas. I usually use IMS data. And using that data, you can get an idea of your ability to penetrate the market, what the the peak sales tend to be in a market, what the uptake curves tend to be in doctors who are served by that market. So looking at the trends from products that have launched into that market previously can give you all kinds of guidance on how your product is likely to launch into that market. You know, while we're waiting, Alex, I'll add a little bit to what I said on the one of the slides about Damasi's work at Tufts. I get asked about that a lot. It has very good comparable data on probabilities of success. So I just wanted to repeat that it's Damasi, D-I-M-A-S-I, at Tufts University. I think he sells his data now, but it's still available, and it's good stuff for probability of success.
Brilliant. Thanks, Joe. There is no other questions. I suppose before we leave, the other thing I was going to ask you, Joe, was so Joe is leading a product valuation one-day course prior to Biopharma America. So I think it'd be a good opportunity, Joe, if you could just explain a little bit about what you'll be covering on that one-day course.
Yeah, that's part of the business development masterclass. We're calling the course Product Valuation and Deal Structuring, and that's exactly what it's all about. It's a pretty intensive day. I would consider it advanced in product valuation, deal structuring, and coming up with terms for deals in biotech, pharma, devices, diagnostics around the trading of assets or the rights to assets. We will spend the day drilling down into the various subjects that go into getting a deal done and structuring a deal. We'll also spend part of the day doing 2 different case studies, so the participants will have a chance to, first of all, which I think is great, interact with the other people in the class so they can learn with them in a case study environment and work on some kind of real world valuation, deal structuring, and deal making work. So we're looking forward to that. It's the day before Biopharma America.
Brilliant. Thank you very much for that, Joe. And I think that's it. We'll leave it there and we'll wrap it up. So thank you very much, Joe, for delivering that webinar. And thank you, everyone, for attending.